Hello and welcome to Market Domination. I'm Julie Hyman, live from our New York City headquarters. We got 1 hour to go until the market close, and it's been a wild session, another one. Our markets and data editor, Jared Blickery, joining me now to help try to make sense of what has been going on. Jared, and I say wild session because obviously we've seen heavy selling over the prior 2 days. Today was selling depending upon the just moment in time that you were looking in the market. We saw a lot of wild gyrations, and they're continuing here in the last hour of trading.
Yes, the NASDAQ is now positive. It flipped from negative to positive in the time that you were saying that just now. I'll just show you a chart real quickly so you can see what's going on. It was kind of scary at the lows this morning. That's the NASDAQ. I'll show you the S&P 500. It was down about 5%. I was fielding questions about the circuit breakers. I had to dust off that old playbook and look up definitions. But it has been a wild day, and you can see the Dow here now down about 300 points, not even 1%. So this it's been a lot worse.
Can I just linger for a moment on this, right? This spike that we saw this morning.
That was a big one.
And it was a big spike, and it looked like it was on what ended up being some mistaken headlines about a potential tariff delay, but then it turned out that that was unattributed, and so, but this is what accounted for that spike, and ever since then we've really seen the continuation of that volatility.
Yes, and you have to wonder how far the market might have gone hadn't we got that false news. So I'm not a proponent of fake news, but interesting the way this has played out. The VIX started the day out at 60. This is just incredible. I'll quickly show you a one-year chart. These are closing prices. So intraday, this is the yen-mageddon Japanese yen flight that we saw. Intraday, it was higher, but this is just going to be the highest level, probably the highest close that we've seen in quite a long time. Probably have to go back to the pandemic all the way in 2020, and there you go for that. Let's take a look at the ICE B of A Move Index. This is year to date. We can see bond volatility on the rise as well. And guess what? If you're in bonds today, you are losing money. That's because the 10-year T-note yield is up 17 basis points. That is huge after it has been falling for several days straight. So it's been difficult to make money in stocks and bonds. And so you got to wonder where the hedge is. US dollar is climbing higher, but I know we want to get to some heat maps here. So let's show the sector action today where we have communication services and tech, those two mega cap sectors. Those are leading the way up right now. What's not working the worst is real estate. Then you got materials, consumer discretionary. And let me just punch up our NASDAQ 100 so we can see what's going on here. Apple is down 4%, Nvidia's up 3%, Tesla up 3%, Amazon, Alphabet, Meta up more than 1%. So it's just a hodgepodge, and if it feels random, I think it is. And just look at the 3-day totals here. There's still a lot of red to come off of here, so we're not.
Is there anything green?
I do not see
over the 3-day period.
I see nothing green.
Nothing
in the NASDAQ 100. You can look at the sector action. Energy is now down 17% in the last 3 sections, and we now have, if I go to a 50, this is percent down from 52-week high. We have at least 4 markets in a bear market: energy, materials, tech, and consumer discretionary. Some of those might trigger on the close, but as I said, this is a very, very fluid situation. And I'll leave us here on the Dow, and another mixed picture, really interesting. Besides the mega caps that we just took a look at, Home Depot down 4%, Caterpillar down 3.5%, Nike similarly situated. But then we got that Jamie Dimon letter this morning, the annual shareholder letter. JPM is up 2%, Walmart up 1%. And let's not forget, we're starting our earnings season, so there is a lot on the table to consider.
Just one other quick note for the S&P 500. We've been talking about being on bear market watch for a lot of different markets. We know the NASDAQ went into a bear market, Dow Jones Transports, the Russell 2000. Now the next one to watch is indeed the S&P 500. And I think right now we are actually...
We're above that level. It's somewhere down here. We crossed it on an intraday basis this morning at one point in time, and that was so quick that you can't even see it on this chart, but we were in that territory, but we are not now. So it looks like I'm not going to say we're giving the all clear here, but we're safe for maybe 10 minutes.
There's no all clears in this kind of a market. It's seemingly. All right. Thank you, Jared. Appreciate it. We're going to hear more from you, of course, as the day rolls on. President Trump's fast-moving tariff policy continuing to puzzle investors. Here with the latest, Yahoo Finance's Washington correspondent, Ben Werschkel. The latest, I believe, that we heard from the president was this morning when he talked about firing back at China in terms of potentially increasing the tariffs even more on that country.
For sure, yeah, Julie. So this came in a post from Trump at 11:14 a.m. After this spike that you and Jared already talked about in the 10 a.m. hour, that also sort of emanated from the White House, and the White House pushing back on that. But his threat at 11 a.m. was against China, and what he announced is that he will do, in addition to what are 54% duties on China set to go into effect this week, he would do an additional 50% in response to China's retaliation. That would put duties at such a level as to essentially make trade impossible. We'll see if he's following through with that in the coming days, but it would set levels at an incredible rate. He's given China until tomorrow to back off their duties, in which point he says he'll go forward. A lot of other kind of fronts here on trade today here in Washington. The Israeli Prime Minister is in with the president this afternoon. They arrived early this afternoon and they're talking. It's unclear what sort of comments we're going to get from there, but Netanyahu said he was coming to Washington specifically to talk about a few issues, but trade being one of them. Israel, which considers itself one of America's closest partners, is on this list of reciprocal tariffs, so it's set to get new duties this week as well. And so Netanyahu's there to talk about that and a few other issues. A lot of other fronts here as well on Capitol Hill. I know you wanted to talk about, Julie.
Yeah, let's talk about that. And by the way, we're waiting to see if there are any headlines coming out of the discussion between President Trump and Prime Minister Netanyahu. Reporters will be asking them questions, so we'll be monitoring that. But in the meantime, Congress has been trying to mount an effort to at least delay or forestall these tariffs in some way. There's a bill that's been gaining some Republican support, and the White House now has a response to that.
Yeah, so the bill here is called the Trade Review Act, and this is a bill that would give Congress, basically take Congress back some of its authority on tariffs, basically allow Congress to review a tariff, and then if they don't respond in 60 days, the tariff disappears. So Congress could essentially veto tariffs. It has shown significant support. There's 7 Republican senators who have expressed their support for it. That's not enough to get to the 60-vote threshold, and with Trump announcing this afternoon he's looking at a veto, that would require 67. So it's got an uphill climb, first in the Senate, then in the House, where Speaker Johnson this afternoon talked about how he is very unlikely to ever bring this to the floor. But it is a sort of show of how these, especially these plain state Republicans, these are folks from like Nebraska, Kansas, Iowa, who are behind this bill. This is the area that they're feeling the pinch most directly, and they're willing to push back to the president on it too. So it's one of the things that's going to be considered this week. Trump's trade representative is also going to be on the Hill this week, so he's expected to get an earful as well.
Yeah, and this coming, of course, after a weekend of mass protests on the streets. So obviously these folks are hearing from their constituents, Ben.
Yeah,
thank
a lot
you
of calls
so
for certain.
Yes,
okay.
Thank you so much. Let's talk more now about the latest market moves amid tariff turmoil. We welcome in Kenny Polcari, Slatestone Wealth Chief Market Strategist. He's going to be hanging with me for the whole show. And Kevin Gordon, Charles Schwab Senior Investment Strategist, also with me. They did not plan their outfits, but maybe they're reflecting the mood of the market in this moment. Not red or green, but black. I think that kind of, we're not at a Black Monday, but, it was possible, right, going into today. Kevin, I'll start with you. I mean, we obviously see a lot of volatility today, people reacting to headlines or perceived headlines. As we sort of take a breath after these couple days of intense selling, what are your thoughts about what happens now?
The honest answer is I have no idea. Nobody does. And I think that, the reflection in the market today, you pointed out that huge spike that we had this morning. And if you actually measure it back to last night's low in futures, it was a 10% jump. Which is pretty remarkable. And then we fell 4 or 5% from there. And then obviously it's been choppy. I think that in and of itself just shows how markets have been keying off of anything that they can get in terms of a comment, whether it's relief on the tariff front. But I think what has actually been probably the more important story today, with all the comments coming out from the president's inner trade circle, whether it's Kevin Hassett or Scott Bessent or Peter Navarro, there is, or even Stephen Moran, who's been giving a speech, there is no sort of clear thread or common thread that they've sort of aligned themselves on. I think that's the tough part, is figuring out, is this negotiation or is this part of the sort of overall process and how they want to address things and focus solely on trade deficits? If it's the latter, then you could see an environment where tariffs do end up ultimately higher and they stay there. And it doesn't necessarily paint itself as more of a negotiation process.
Yeah, I mean, in Navarro, I believe, saying today, we're not negotiating.
Yeah.
Then you have other officials saying, yes, Bessent in particular saying, yes, we are negotiating, but it takes a long time to negotiate these kinds of deals. These are not comforting words for the market.
No, they're not, and that's what makes the market so chaotic, right? Because the market, the one thing the market doesn't like is all the uncertainty, right? It can deal with, if the news is bad, it can deal with it, and you can price it and move on. But when one day it's yes, the next day it's no, the next day it's yes, the next day it creates all this chaos and this very uneasy, anxious feeling, which is why exactly what you saw today, the market started lower. We got this one headline, which while it was false, it was this positive headline that people perceived it, and the market immediately turned around and ran up. The minute they denied it, you saw what happened. The market went right back to negative. Now, it is funny because I want to see how we end the day. We're just kissing really the unchanged line, which is remarkable considering all the stress we saw global markets under overnight. Asia certainly, and Europe.
I mean, and certainty and uncertainty feel like they mean different things now, Kevin. And what I mean by that is, even if the administration came out tomorrow and said, we screwed up, obviously this is not going to happen, but even if they did, even if they came out and said, we messed up, we're gonna do 10% and that's it. That's across the board. Have they done enough to damage their credibility that it wouldn't reassure the market?
I think that's the ultimate question, and unfortunately, I don't think we'll have clear answers to that until you get well into the summer. And I say that because whether this is now something that has its own momentum and the risks to the downside for the economy have sort of snowballed on their own, and it doesn't necessarily matter what the administration says from here, I think there is a risk at some point where businesses just don't take those announcements seriously. Because if it is this on again, off again, the rules of the game are constantly changing scenario, that is basically the worst place you could be for a business. Trying to plan, put together some sort of CapEx plan or put together some sort of hiring plan. If businesses don't know the rules of the game, then they're not going to play. So the reality is such that the back and forth and the constant changing of the rules is probably, in our opinion, what's going to contribute to more of a slowdown. So I think, in that scenario, let's say they do come out with some sort of baseline and they keep it at that, I think that you do probably just move into a stagnation, not an outright recessionary phase. But that's not the best place to be. That means you probably stay in the low hiring, low firing environment. It probably means that business investment slows and you don't get any sort of progress on any front that anyone's going for, whether it's bringing manufacturing back to the U.S., whether it's trying to close the trade deficit. I would think in that scenario, probably none of that gets accomplished.
Yeah, I mean, it's hard to imagine a long-term situation in which the tariffs on China are 54% or Vietnam are 46%, et cetera.
Well, I don't think they're going to. Look, we already saw over the weekend, Vietnam, Taiwan, even Japan is sending a delegation to the White House because they've already said they want zero rates. They're willing to negotiate.
Right, but we've been hearing from some people in the White House, no thanks, we're not interested. So what do you do with that?
That's confusing because on the one hand, they're getting what they want, and then they say, well, we're not interested. What does that mean?
But they're not getting what they want if what they want is to even up the trade deficit, which makes no sense for a country of Vietnam's size to buy as much from us as we buy from them.
Right. Which is why you need to have that conversation. And I do think, I'm on the Scott Bessent side. I absolutely think that they're negotiating, they're willing to negotiate. I don't buy the Peter Navarro thing saying, no, we're not negotiating. I don't think that's true. I just don't think it's true. I'm in Scott's case where he said, look, it may be long, but we're going to negotiate. We're going to try to get this right. And I think that is what's going to happen. According to the White House, there are 50 countries that came up and said, look, we'll come over and we raise our hand, we'll come over, we'll have these negotiations. I'm not going to say everyone's going to get exactly what they want, but if they're willing to negotiate and there's a new trade agreement that's made with these countries, then I think ultimately that's bullish.
I think the difficulty in all of this, and you sort of started alluding to it, Julie, is that the so-called negotiations or the concessions that we're supposed to be theoretically getting from other countries, those, at least right now to date, seem to be based on tariff rates. Right. The reciprocal tariffs that were announced last week are based on trade deficits. So if you're only negotiating, as a foreign country, if you're negotiating down your tariff rates, that has nothing to do with the trade deficit. Right. So, and we know from the language coming out of the White House last night and even out of this morning, that the focus is on trade deficits. Yes. So I think that's the part that seems sort of contradictory and creates a little bit of this vicious circle where you can get all the concessions you want on tariff rates coming down, but is Vietnam going to take 25% of its GDP and then just automatically start spending more on U.S. goods to even it out? Right. And that's the difficulty, I think, is that there's two sort of separate tracks to this.
Okay, so all of this said, Kevin, what the heck did people do, right? We look at history, even post-financial crisis, stocks, yes, they recovered, right? So do people just hold tight? Do they even buy the dip? We're still seeing some retail buying of the dip here.
I mean, well, the behavior has been such that there has been a lot of dip buying. I think that as a strategy, of course, it'll depend on everybody's, especially for the client base we have, it depends on everybody's situation. We're always sort of quick to say that neither panic nor hope are investing strategies. So in the best of times, hope is not a strategy, and the worst of times, panic is not. I do think that within and across asset classes, not just domestically, but also internationally, the past couple of weeks, I would even broaden it to year to date because of how well ex-US markets have done. This has been the best case to be made in terms of staying diversified. And I think that sometimes you can get caught up in thinking that that's not the best strategy, especially when you have a huge, mega cap tech run in the US over the past several years. Right. That's gotten hit the hardest recently. Not to say that gains over the past 3 or 4 years have not been good, but I think that these kinds of moments really emphasize and sort of put that exclamation point on why diversification is strong. Especially because even if you're in the bond market, yes, yields have retraced where they were from last Wednesday, but you're still getting a healthy yield if you're holding bonds for the life.
100%. And look, to your point, I think what the market has done, where we've gone, I think it presents a big opportunity for the long-term investor. You got to stick to high quality, you got to stick to mega cap names in the sectors. But if you look at names like NVIDIA that are down from $150, basically, it's trading at 86 today, it's NVIDIA. Consider where it sits in the nexus of AI and how that's changing the world. I think it's a huge opportunity for some really significant big names. So yes, I'm all into buying the dip.
Well, we're going to hear more from you, Kenny, throughout the show. Kevin, thank you so much for coming in.
Nice
Great
to
see
see
you.
Good to see you.
Kevin, love the outfit.
Likewise.
Kenny's sticker in until 5. I'm glad I wore a bright color today.
Yes, I'm
otherwise,
glad you did. Break
be
this
trouble.
up.
All right, coming up next on Market Domination, because we're just getting started here, we're going to check in on some of today's top trending tickers, including shares of U.S. Steel getting a big boost. Plus, Microsoft hit a 52-week low, but is there more downside to come? We're going to speak with an analyst this hour to help strategize around tech stocks generally. Stick around, much more Market Domination still to come. Now, time for some of today's trending tickers. We're checking in on U.S. Steel, GM, and Caterpillar. First up is U.S. Steel, and those shares are surging today on news that President Trump has ordered a review of the previously blocked acquisition of the company by Nippon Steel. This is raising some hopes that it could reopen the door here. CFIUS is the body that does this review here, the Committee on Foreign Investment in the United States, and the report is due in 45 days. Of course, President Biden had blocked this deal from happening. Trump has indicated maybe he would be open to some version of this, maybe where the Japanese company would invest in U.S. Steel but not own it. Kenny, it's been an interesting situation amidst the backdrop of everything that's going on.
Yeah. Now, I was in the camp that I thought we shouldn't sell it. I will say I was in that Biden camp that thought maybe we shouldn't. But if there's a different version that allows the Japanese to come in and make it a substantial investment, they're going to help, revive the company. They're going to concentrate on producing steel in the United States. I can't necessarily say that I would be against it. I'd have to see what that version looks like.
It's a tough situation. The steelworkers union is against it, but U.S. Steel says we can't continue to afford to operate. So then steelworkers would end up losing their jobs. It's a tough choice.
It is a tough choice, and I suppose again, like everyone else, maybe if there's a version that seems applicable, then maybe the steelworkers should sit and listen to it, and then maybe they'll change their mind.
Yeah. All right, let's get to our next mover here, and that is General Motors. Bernstein is downgrading the automaker to underperform from market perform, warning that new vehicle tariffs and a likely decline in consumer sentiment will significantly pressure the company's earnings and cash flow. I can't say I'm shocked by this one because Daniel Roska, who is behind the call, he was in our studio right after those auto tariffs were announced. And he sounded quite negative about the effects that this was going to have on the company. He said, if you look at tariff costs, price hikes, market share gains, and a decline in consumer sentiment, auto free cash flow will be reduced by $6 billion between 2025 and 2027. That's what they're cutting their estimates by.
But if you heard Trump made the suggestion that he thought he was going to allow car purchases to once again be deductible. Like if you go out and you take a loan to buy the car.
Right.
You used to be able to write that interest off as a deduction. Then they took it away. And now he's thinking about, okay, I might put that deduction back in, encouraging people to want to go out and buy a car. If you can deduct your interest, if you finance the car, it's quote unquote a net benefit to you. That maybe that should blunt that a little bit.
But is that something that would need to be in the tax bill? It's not. That's not something he can sign an EO on.
No. It would have to be part of
So
the.
it would have to wait.
Yes, but it would if they talk about putting it in there and they talk about, look, the price of a car. Have you gone out to buy a car recently? They're
in the last couple of years.
They're out of control, the price of a car. Yeah. It's funny because, I brought my wife drives an Infiniti, a 2020 Infiniti. It's fine. I live in Florida. It doesn't have the weather around here that destroys cars right now. Anyway, it's fine. I brought it in to be serviced, and the woman comes in. She said, "Would like to interest you in a new same car, just a 2025 version."
Yes. How much more was it?
They wanted $1,250 for a 3-year lease if I wanted to lease it. The car was $85,000. Look, I get it. I'm not cheap, but I'm sitting here going, okay, my car's perfectly fine. Why am I going out to buy it? And why do I want to pay $250 on a lease?
A lot of people are making decisions like that right
I guess they are.
Yeah.
I mean, I said, no, I'm not interested. But I suppose if Trump says, well, listen, buy the car now, finance it, you get to write it off, maybe it makes people think, well, maybe I could do that.
Yeah. I think that's a common feeling. Let's get to our next one, Caterpillar. This is a downgrade also from UBS in this case, and the bank warns that macroeconomic risks linked to tariffs and weakening global demand are not yet fully reflected in this stock, and they say they expect further earnings downside as second-order impacts from tariffs and recessionary pressures weigh on demand across construction, oil and gas, and mining markets. And by the way, Caterpillar, people don't realize Caterpillar's biggest part of its business is now the energy business.
Right.
Equipment for the energy industry. And you saw what Jared showed earlier in terms of the energy stocks, which have really been hammered. Oil prices are down. That is not good for their spending power. I thought another quick thing that was interesting about this note, they say that whatever Caterpillar says in earnings could be overwhelmed by this recessionary concern.
And it could be because it would be, I think, if there's this big recessionary concern. But look, when you talk about the energy sector and Caterpillar's role in it, oil prices have come down. That's great for inflation. It's great for the consumer, manufacturing, all that. But at some point, where's the break even for oil companies? Is it $55? Is it $60? If oil goes much below 55, then you're going to have difficulty for the oil companies. And yes, that will directly impact Caterpillar if that's part of their, to your point, one of their biggest sectors now, right?
Yes.
So it's kind of, it's iffy. You want prices to come down. You want oil prices to come down because it helps everything, transportation, manufacturing, food costs because of the transportation.
Right.
But then you want to be careful that you don't bankrupt the energy companies.
Yes, well, that's always been one of the tricky messages coming in with this administration and the so-called drill, baby, drill. It's not necessarily what the companies want to do.
No.
All right, let's zoom out for a moment. Trump's tariff turmoil continues to rattle markets and spur worries over the future of the U.S. economy. Goldman Sachs, for example, raising its forecast for the odds of a U.S. recession. That's the second one we've seen in a week. Here with more on all of this talk of recession, Stifel chief economist Lindsay Piegza. It's good to see you, Lindsay. I'm curious where you are on this question of whether the probability of a recession is rising, and if so, how likely is it, and what are you going to be watching?
Well, I think the probability of a recession is very real in the next year. We put it at about a 20% probability. So it's certainly not a zero probability, but that being said, it's not our base case either, as we continue to see relatively solid performance out of the U.S. economy. Now, the seemingly aggressive fiscal policy agenda coming down the pipeline does threaten growth, particularly in the first half of the year. But much of that is consumers and businesses responding in anticipation of a realized result from these policies. And we do expect perhaps the perception to be worse than the reality, allowing growth to move back into positive territory, more positive territory, meaning 1.5% to 2% in the back half of the year. Now, inflation is a different story. We do expect this sticky level of inflation to be exacerbated by tariffs and remain closer to 3% through the end of the year.
Lindsay, it's Kenny Polcari. How are you?
I'm good. How are you?
I'm good, thank you. Listen, you and I are very much in that same camp because I agree with everything you said. I think inflation is going to remain sticky. I don't think the Fed is going to be able to. I was in the camp that the Fed was not going to be able to cut rates this year, and I'm still kind of leaning in that camp because I think the inflation story is the one that's going to remain sticky. Now, I understand this whole tariff chaos that's happening and what it's doing and the perception it's creating, and I wonder if people are talking up this recession. It's almost like, if you say it enough times, it just happens, right? Which I certainly don't want to see happen. I don't think it's going to happen. But tell me your view on the Fed. Where do you think they are? Are they in a tough spot?
Well, I think the Fed right now is focusing more on the potential emerging weakness in the U.S. economy. As we've seen historically, the Fed is willing to tolerate above target inflation for some time. In fact, if we go back to the post-COVID environment, I believe the Fed stopped well short of a sufficiently restrictive level to get price pressures back under control. So there was much of this lingering inflationary turmoil that has nothing to do with tariffs that the Fed was still contending with. But even so, I think the Fed, looking at the level of policy right now, still in firm territory, would feel comfortable justifying maybe 1 to 2 additional rate cuts to get us back into neutral territory. The Fed isn't talking about providing undue support to an ailing economy, but they are trying to get policy back to a neutral level, which would give them justification for about a 50 basis point reduction. So some further relief, but certainly not in the camp of some of the more aggressive policy outlooks calling for 4 or 5 rate cuts in the remaining 9 months.
And Lindsay, I want to go back to something that Kenny just mentioned about sort of the idea that we can talk ourselves into a recession. I was struck by another headline today, this one from Larry Fink, of course, of BlackRock. He was speaking at the Economic Club of New York today. One of the things he says is most CEOs he says he talks to say we're already in a recession. As an economist, how do you think of that idea of sentiment driving us there? Is that how it works?
Well, the Fed talked about this, the disconnect that we're seeing between the survey data and the real data. Consumers' inflation expectations, for example, skyrocketing 170 basis points. Businesses reporting unprecedented levels of uncertainty. 90% of businesses say that now is not a good time to hire, now is not a good time to expand their business. And so there is some of that that sentiment that translates into a self-fulfilling prophecy, right, which is likely causing the material downturn that we expect in the first quarter. Because remember, the impact of the tariffs is not going to be affecting the real data in the first quarter. But again, it's that sentiment, it's that uncertainty that's driving businesses and consumers to the sideline. But again, our base case is, yes, a dip in momentum, a dip in activity in the first half of the year, but retracing a lot of that lost activity by the back half of 25.
Something else I wanted to ask you about, another comment that I saw today, this one from Sean Fain of the United Auto Workers. He stated in an interview he doesn't have much sympathy for people who hold stock, who are upset about the declines in the market right now. He says 60% of Americans have no retirement savings, which I think that number is a little higher than the actual number. But he says this is just Wall Street. It's people that are already rich. And most working class people are just trying to survive right now. But talk us through the relationship between the market and the economy. I know a lot of people say the market's not the economy. But when the market goes down by this much, it can become an economic problem, can it not?
Well, it certainly feeds into just what we were talking about, the sentiment of the economy. When the average American, whether or not they have a stake in the equity market, sees this negative reaction in the market, it can perpetuate concerns of a downturn, of a recession, of potential hardships coming down the pipeline. Yeah. So again, it can feed into that self-fulfilling prophecy, potentially exacerbating the realized downturn that would otherwise have been more muted if sentiment had been maintained in a more positive message.
Right. I think, Lindsay, I think the comments from Sean Fain are really short-sighted because all those union workers, their pension, where is it, just sitting in cash, or is it invested in the broad stock market for all those people? So for him to say, that 60% of the people don't care, he should turn around and talk to his own union members and see if they care what's happening to their pension and potentially their pension and 401ks, no?
Well, I think when we talk about these policies, it does come down to the timeline that we're assessing it through, the near term or the long term. Near term, there is likely to be some pain, be that in the equity market, be that in a downturn in the economy, higher prices. But the focus should be on the longer run reset of the global economy or the global international trade market as we talk about potentially revitalizing American manufacturing, creating longer term domestic jobs. But we can't bring factories back overnight. We can't expand production overnight. So again, a lot of the focus, a lot of the conversation needs to be divided clearly between the near-term implications and the potential long-run results from these policies.
Well, and Lindsay, let's talk about the long-run results, and then we'll leave it there. Do you think that what's happening right now is an effective way to achieve that goal, that sort of revitalizing the middle class and lower middle class of the U.S. by trying to bring that manufacturing back? Is it going to be successful? Is this the way to do it? Is that even a worthy goal?
Well, it certainly remains to be seen whether or not this is a goal that can be achieved. But at the very least, I think I applaud the administration for trying to focus on a longer term goal to lift up many of the sectors of the U.S. economy that have been left behind, many of the individuals in the economy that have been left behind. But in the near term, there could be some sizable disruptions, particularly those for the middle or lower end of the income spectrum, if we do see this translate into a material loss of growth, into a material increase in additional prices, which are burdensome in and of themselves. But this is compounding on top of years of already massive price increases. When we look at housing, food, transportation, costs have risen nearly 30% over the last 5 years. So it really remains to be seen whether the average American is willing or able to stomach any additional cost increases, even in the near term, for the potential long-run benefits of these policies.
Right. Lindsay, thank you so much for joining us. Appreciate it.
Thank you.
I wanted to check on another group here, and that's U.S.-listed shares of Chinese companies. They're under pressure as President Trump is now threatening more tariffs on China. He said this morning on social media that the United States will impose additional tariffs on China of 50%. Now, if you recall, the tariffs on China that are set to go into place are already 54%. So that would be a lot of tariff. I'm taking a look at the Wi-Fi Interactive here. We just showed a few of those China stocks. This is a bigger look here, what we've seen. There's Alibaba, PDD, NetEase, JD.com. So you see obviously broad selling. I'm going to take it to the 3-day look because as we did earlier with Jared, that shows that since the beginning of the sell-off, obviously then you have that additional headline today. But Baba falling almost 19% in that time.
None of that is surprising, right? Yeah. Based on what the headlines are. But you know, it's interesting, and I think I said this to you once before. I don't buy Chinese stocks. I just think there's so many other places for me to put my money. But I'm not surprised by what we're seeing, considering the level of rhetoric that's coming out of the White House towards China, and the fact that China's pushing back and saying, too bad.
And there's also been some interesting reporting out of the Wall Street Journal that the two sides, unlike many of the other sides that have tried to negotiate, Beijing has tried to sort of go through traditional diplomatic channels. Right. They've done it the same way for many years. And it looks like with the Trump administration, that is just not an approach that works. They like a more informal, direct.
But he likes Truth Social. He wants to negotiate
he wants them to tweet
on
it.
Truth Social.
Yeah, well.
You know, but it is to your point.
That doesn't seem to be happening with the Chinese anytime soon.
No, not at all. Yeah. And to your point, I actually think that the Chinese stocks, I think they could continue to come under pressure.
Okay. All right. Well, coming up, Citi upgrading its outlook on some of the discount retailers. We're going to take a deeper dive with our call of the day. Stick around, much more market domination still to come. Time now for our call of the day. Citi is upgrading Dollar General from sell to neutral and Dollar Tree from neutral to buy. Joining us now with more, Yahoo Finance's Brooke DePalma. So, getting a little bit less negative, I guess, on some of these.
A little less negative for Dollar Tree. That was one of the companies that took a hit because roughly half of their imports are from China. Think of Dollar Tree as more of a general merchandise type retailer. Now, Citi upgrading shares of Dollar Tree because of the fact that they said in this sort of environment, if everybody's raising prices here, well, then they said that they could justify Dollar Tree increasing their prices. We did see a few years back, see Dollar Tree increase prices from $1 to $1.25. Now, Citi saying that they could even justify raising prices from $1.25 to say $1.50 and $1.75. And those are prices that shoppers, especially in this sort of environment, could swallow here. Now, keep in mind, Dollar General, they do sell more consumables, more food, essentially. And so Citi analysts here are saying that they don't have the same type of tariff risk that other retailers have. We know that roughly 10% of Dollar General's sales are affected by tariffs. And we also know that roughly 80% of what they sell is, say, things like canned soup, beans, chips, those sort of canned foods as well.
And there's another group within retail that's getting attention again. I remember this happened during the supply chain hiccups during the pandemic. Right. The off-price retailers, because some see an opportunity there when there are sort of these disruptions, they can like get extra merchandise. Is that how it works?
Exactly. So some are saying that the retailers are going to pull forward inventory here. And what that could mean is that between Q2 and Q4, all these specialty retailers are going to have a lot of extra inventory that they tried to get ahead of tariffs with. And so that could be good for, say, TJX. Yep.
TJ Maxx is going to have a ball with that.
They're going to have a shopping spree, essentially, if this does happen. And we do see this happen. Also, keep in mind that in this sort of environment, everybody wants value. All these consumers, they're turning to low price. And so that could bode well should there be an increase in foot traffic as consumers are really pinching and watching their wallet.
Yeah. All right. Thank you so much, Brooke. Appreciate it. We've got breaking news now. President Trump speaking after holding a bilateral meeting with Israeli Prime Minister Benjamin Netanyahu addressing the increased China tariffs.
They put a 34% tariff on above what their ridiculous tariffs were already. And I said, if that tariff isn't removed by tomorrow at 12 o'clock, we're putting a 50% tariff on above the tariffs that we put on.
According to our next guest, market-rattling tariffs offer one upside. Companies can use the shifting financial landscape to adjust their performance goals, calling the current macroeconomic uncertainty a free hall pass for tech giants. Joining us now is Brent Thill, senior analyst at Jefferies, to talk more about how all of this. We're not talking to Brent quite yet. Okay, so let us talk to Kenny Polcari, who is still with me. Indeed, we have these comments from President Trump, and it doesn't feel like things are that much clearer here.
No, they're not. And I think we're going to continue to get that lack of clarity because, again, he says it, he doesn't say it. Somebody else says it, then he denies it. And then, he floats the idea that maybe. And so the markets continue to try to respond to every headline. But at some point, the market's just going to stand back and say, you know what? It's going to sell until we get some clarity. Now, I don't want to see that happen, but at some point, investors will get frustrated with the lack of direction.
Yeah. I mean, it doesn't seem like that direction and clarity is coming remotely soon.
It doesn't feel like it, but it's funny because look at how the market's reacting today. What we all thought was going to be another really negative day today has not turned out to be that bad. While we may end up down a little bit, it's not going to be down the 5 or 6% that we saw the Asian markets and the European markets, right? So there's a little bit of relief from that, and I think it's giving people the sense that the sellers are getting exhausted. While that doesn't mean that prices are going to go straight up, it just might mean that we've kind of hit a level where it's okay for now until it gets more clarity, whether it's through earnings season, whether it's through the next Fed meeting.
We'll see. But let's get a check on the markets at the moment here, because it really has been a moment-by-moment situation. Right now, the Dow is trading lower by about 1.4%, the S&P 500 by about 2/3, and the NASDAQ is down about 0.4%. But, the NASDAQ keeps sort of flickering into positive and then coming back down again.
But that's a win considering what we saw overnight and this morning with the Dow, the S&P, the NASDAQ all down 3-4%, almost 4.5%. right?
It's just a day. I
Yes,
wouldn't call
correct.
it a win just
but,
yet. But yes, for sure, comparatively to where it was.
And what everyone, a lot of people, by the way, were bracing for this Black Monday type of move. You know, they were all announcing the circuit breakers, and here they go, and this is where it's going to be, and then the second circuit break. You know, so people were preparing for kind of a really, really uncomfortable day, and we didn't get it.
Not yet. There's still
Not yet.
15 minutes to go, 14 minutes to go. All right, stick around. Much more market domination still to come. Stocks are lower, I believe, ahead of the closing bell. They've been changing moment by moment. Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist, is joining us now. Keith, it is fantastic to see you after what has been a wild few sessions in the market here. And I know that you took a step back in February, and you said, you know what, maybe we should be a little bit neutral here. I'm curious at that point, what was sort of the catalyst for you? And are you still sticking with that neutral kind of view in the face of what's been going on?
Yeah, well, hey, great to be with you, Julie. You're right. Back in February, when we look at the way of the evidence in our work, it just suggested that the risk reward had deteriorated from where it was prior, where we had been very bullish. And some of the things we had looked at is we already started to see the economy cool somewhat even before this tariff news. We had gone the longest stretch of this bull market without even a 5% pullback. That told us that we were more vulnerable. We started to see earnings flatline somewhat. At the same token, when stocks made new highs in February, only about, when the S&P made a new all-time high, only about 50% of stocks were making new highs. So we put that all together ahead of all this event risk. We just thought the market was being somewhat complacent. So that's I guess, maybe answer to the first part of your question. The second part of your question, our overall strategy is still somewhat more neutral. But the main thing we're talking to our clients, our advisors today, is that we would not be selling into this panic that we're seeing short term. At least now, you are starting to discount some of these uncertainties. Not saying that this is the end of the decline, but what we're also saying is that we should be thinking about two-way risk, not just risk to the downside, but there's also risk now to the upside. So it's become a bit more favorable than I would say where it was in February, where again, we weren't pricing in any risk in that point.
Keith, how are you? It's Kenny Polcari. Let me ask you a question about targets. Now that we broke through 5,000, earlier today we were trading in 49, I think 49.75-ish. I think that was a low, might have been a little bit lower. But now that we've broken that kind of psychological 5,000 level, depending on where we close tonight, where do you see it in short term? Do you see us testing potentially a little bit lower? Because I view that, we're not going to have this V-shaped recovery. Things aren't going to rally right back, that we're going to churn for a little bit and maybe just churn a little bit lower. I don't think we're going to have these, down 5 and 6% days like we just had for the last couple of days. I think it's kind of stabilizing. And there are some big name stocks that are actually becoming a value play.
Yeah, well, great to see you, Kenny. So we actually put a note out last night, and what we're referencing more importantly is is around the 4,800 level on the S&P. Right. The 4,800 level is the 50% retracement of the 2002 to 2025 bull market. So if we look at that uptrend to the recent pullback, it's almost a perfect 50%. That level, that roughly 4,800 level, also overlaps with the highs from 2021. So that's exactly where we stopped today. We're at 48.35. So I think that's the important near-term level, Kenny, in our work. And then the other thing I would say, too, is that about the volatility. We put out a note last night looking around at these big two down days in a row. And what the work clearly shows is that volatility tends to cluster. And what's also notable, within the next 2 weeks, not only you go from having one of the worst 2 down days to having one of the best 2 up days, meaning it's not unusual to see some type of rally in the 9%, 12% at some point over the next few weeks. It may come up from different levels. So to your point, I actually think that we will see some pretty choppy action. What happens after that shock period, you have this battle between fear and greed. Fear that we have more downside, so people are looking to sell, and those that are more greedy or looking at opportunity to buy. So we create this kind of back and forth, which I think is likely to continue here in the near term.
Yeah.
Well, and I was going to say, we're also getting into earnings, right? We've got JP Morgan reporting on Friday. Are we just now setting up for just a relentless parade of earnings calls where people say, we're not going to issue a forecast, for example, because we are too nervous to do so, or we're going to cut our forecast? I mean, are we looking at a sort of doom and gloom earnings season here?
Yeah, I don't know if you're a CFO or a CEO, especially of a multinational company, I mean, how much clarity do you have? How much confidence do you want to go out with some confidence in an outlook? But here's the reality, though. We've just seen a contraction in the S&P PE by about 3.5% to 4%. We have more than a 17% correction. The market knows that cuts are coming, right? So the question is, how big will they be, and how broad based? Because again, the market is correcting based on that already. So I think what I'm going to be looking for into the earnings season is maybe less about what companies are saying and more, how do these stocks act? Especially some of these ones that have been really beating up, call it in retail, or some of these areas that really have been walloped. When you have a cut, do the stocks react and move higher? That will tell you that more of this news is already priced in. But that's the key in our view. And I will also say, on the upside, I still think, and this is a ways away, but I think that 56, 5,700 is really going to cap the upside for some time. So we're going to be in this choppier period for some time.
Yeah, I think. Keith? What are you expecting for earnings season broadly? Are you expecting to see this? I think the growth is expected to be about now 7.5%. Right? I think it was 12 at the beginning of the year. That's come down to. I think it's about 7.5% right now. Is it not?
Yeah, it's somewhere around there. I mean, Kenny, you and I have both been doing this for a while. Like, somehow the companies will come in and they'll, as far as the beats relative to expectations, my guess is they'll still be around 70% or higher. I mean, they did that through the financial crisis. I think what you'll start to see is this pickup in the guidance, the negative guidance going forward, or the pulling back as well. And probably what you're going to just see is really almost wide swings. Like, hey, this company really has handled this better. They're actually better equipped for this versus, oh, this is more of a surprise. So it's going to be this, wide.
Okay. Keith.
Let's just pause and take the closing bell here on Wall Street as we close out another unusual day in the markets here. Not as much selling, but an unusual day. So let's talk about where the major averages ended the day. The Dow actually doing the worst of the three major averages today, which is a little bit different than what we've been seeing recently, where the brunt of the selling has been borne by the NASDAQ. Right now, we've got the Dow down by about 350 points, off about 1%. As we spoke about, there were some misguided headlines earlier in the day that caused a brief spike in the Dow. But besides that, it has been the most consistently lower of the three major averages. The S&P 500 down about 0.25% when all was said and done, but it too flirted with positive a couple times. And the NASDAQ actually did manage to gain by the end of the day, with the tech names being the strongest performers as groups, even though there were some notable outliers. But overall, seeing tech perform the best today, even though it was just up 0.1%. Jared Blickery's got a closer look at the action today. Hey, Jared.
Thank you, Julie. Up, down, the name of the game has been volatility. The true range of the S&P 500, that's basically how much it fluctuated up and down, 8%. We haven't seen that in quite some time. You and I are going to do a postmortem in about 30 minutes, so I'll save the best for that conversation. But let's take a look at the VIX real quickly. So, settling down about 48, 43. I like to look at the bond market VIX as well. This is going to be a year-to-date. That is at year-to-date highs, and we saw the 10-year T-note reverse upwards. The yield was up 17 basis points today. Here's an intraday. That is a lot to happen in the bond market. But let's get to some heat maps so we can get a visual idea of what's been going on today. And tech managed to end up 63 basis points. Not quite up to the highs that we saw earlier this morning on that false news, but nevertheless impressive that we were able to find any green today. Communication services as well in the green. And then to the downside, real estate down 2.4%, materials, utilities, staples, consumer discretionary, all down 1% or more. And here's the final tally on the NASDAQ 100. Really mixed picture, especially with regard to the mega caps. You got Apple down 3.5%, Microsoft down half, Tesla down 2.5%, but Broadcom up 5%, Meta up 2%, Nvidia up 3.5%. And so we're just seeing these big outsized movements here. And we also see this in the Dow to some degree. We were talking earlier, Home Depot down 3.5%, Travelers down 3.5%, but JP Morgan, which issued a little guidance this morning ahead of Friday, that was up 2%. And let's take a look at the transports as well. Kind of a mixed picture there. Uber up 1.5%, United in the green up almost 2%. For the most part, though, seeing a lot more red than green. FedEx and UPS each down more than 2%. And taking a look at some of our leaders here, we got stocks, we got chip stocks in the leadership position. Those were up 2.3%. And then to the downside, the biggest decline we saw was in Bitcoin, which plunged below 80,000. We'll also talk about that in a few minutes, Julie.
Yes, looking forward to that in the takeaways. Well, for more of the markets, let's welcome back in Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. And of course, Kenny Quell-Carey is still with me for the full show. Keith, all of this said, what do we do as investors, right? And I was looking at some of your sector allocations, which I thought were pretty interesting. You still like utilities here. Utilities has been a group that's been was hot last year, tied to the AI trade. It has sold off some this year. What's your current thinking here on sort of the utilities dynamics in this environment?
Yeah, well, and I would probably put this in broader context. We have utilities as an overweight, we have communication services, and we have financials. And if you think about that, those are three different areas. Like one's a defensive, one's more of a growth and one's more of a cyclical. And if we're going to have this choppy market going back and forth, we're trying to find the best one of each sector. So, and I think if we have a little bit of a rally here, which I think we actually will on a short-term basis, utilities will likely underperform, but I think it will provide stability as we're thinking over the next 3 months, 6 months. They don't have tariff exposure really. Solid dividend, about above 3%, trading at a discount, relative price trends somewhat positive. I also think what you saw, what Jared just showed on the board, I do think some money will rotate back into tech short term. We are neutral tech, but we are overweight communication services. I was just looking this morning, the Mag 7 PE in July of last year was around 33, 34. Now it's down to about 22. That's the same level it was around October of 2022, right around ChatGPT came out. Now, there are some risk with earnings going forward, so I want to keep that in mind. But I think during this period, you will likely see now, after these stocks have been hit, a rotation back. So I would also look at communication services as well. And more broadly, Julie asked the question, what do you do here? I mean, first of all, we're telling our clients, if you have a lot of cash, it's going to be a bit of a bumpy ride, dollar cost average into the market. Also, if you're panicking, we don't think this is the right time to be selling after you're down 17%